Welcome everyone. Thank you very much for joining us for today's webinar on listed infrastructure, thematic opportunities for the modern age, presented by Alex Araujo. My name is Sebastián Roda, and I'm one of the board members of the CFA Society here in Uruguay. As you know, one of the main objectives of our CFA Society is to deliver value to our stakeholders and promote the development of the high standards in the financial practice. In line with this mission, back in October 2020, we signed a partnership with M&G Investments, one of the global leaders asset managers. And this partnership has allowed us to work together and advance in the exchange of knowledge experiences, financial literacy, and the development of activities for the dissemination of the best financial practices. For this reason is that today we have the pleasure to present this webinar on listed infrastructure, a market that has gained more interest during the last year as an alternative way to deploy capital in this asset class, but also more focus on thematic opportunities coming ahead. Just a little housekeeping before we get started. The presentation will last something between 30 and 40 minutes. And then we will have a 15 to 20 minutes Q&A session. If you do have any question during the presentation, please feel free to type them into the chat and I will bring them up at the end of the presentation. You may also send it directly to me. Please double check your microphone at this moment and check that it's on mute during the speech. Again, at the end of the presentation, we will have this Q&A and you will be able to unmute and ask your question to Alex. So now, without further ado, please let me introduce our presenter today, Alex Araujo. So he graduated from the University of Toronto with a master's degree in economics and is also a CFA charter holder. He has more than 25 years of experience in the financial markets, having previously worked at UBS and BMO Financial Group. He joined M&G almost 6 years ago and was appointed co-deputy fund manager of the M&G Global Dividend Fund in 2016. Then in 2017 was appointed manager of the M&G Global Infrastructure Listed Fund. And a couple of years ago, in 2019, he was appointed manager of the M&G Global Themes Fund. So Alex, it's a real pleasure to have you here today with you. So the microphone, it's all yours.
Sebastián, thank you very much. The pleasure is mine. I'm very glad to be here. I do have the distinction of having been a member of the CFA Society in 2 countries. I'm Canadian, I'm British, and I'm also Portuguese. I did offer to give this presentation in Portuguese, but I was told English would probably be better. So it's a pleasure to be here. As you say, I do manage a global listed infrastructure fund. This is an asset class that's very close to my heart. We did launch this fund 3.5 years ago, and it's been a very successful product launch with thousands of clients invested in this strategy, which gives them access to the characteristics and the aspects of an asset class that I believe is very, very exciting. So what I will do is I will share my screen and I will take you through a very high level, perhaps even a macroeconomic run through of the opportunity in this asset class. It is, of course, very, very topical at this moment across the world. And I would say that I'm even more excited about its future now than I was 3.5 years ago when we launched the fund, which is saying a lot because I tend to get quite excited about this asset class. So the agenda. There is a critical need to address the infrastructure gap globally. There is a tailwind of fiscal stimulus, which of course comes on the back of the worst economic recession that we have arguably ever seen in peacetime. as a result of the global health pandemic. And we have some very powerful and exciting long-term trends that are supporting this asset class. It is an asset class that is distinct from others in many ways. We express our investments through the listed space specifically, but in the private realm, as you're probably very, very well aware, there are significant private investments in the infrastructure asset class. So what is the problem? The problem is there has been chronic underinvestment in critical assets. And this is mostly a situation specific to the developed world. It might surprise most people. And the reason for that is if we look at the history of infrastructure build, and this is the United States, which has arguably the worst state of infrastructure in the developed world. The investment in infrastructure by governments has been falling steadily.
Sorry, I interrupt you, but we cannot see the slides.
You can't see the slides. I'm very,
yes,
very
I'm
sorry.
really sorry for interrupting you.
No, this is probably my fault, and I do apologize. Let's try this again. I apologize, everyone. You haven't missed much, don't worry. As you can tell, I am not a technology expert. There we go. Please tell me if you can see them now.
Yes, we do. Thank you.
Very good. Okay, so I'll skip to where I was talking. You didn't miss much. The need to address the gap, the tailwind of fiscal stimulus, and the powerful long-term trends. These are just a couple of images about how bad things are in the United States, and it is a result, as I mentioned, of the lack of investment in infrastructure. Historically, and in particular after the Second World War, infrastructure was mainly the responsibility of the federal government, as well as state governments. There was a coordinated effort under President Dwight Eisenhower to build an interstate highway network, which was world-class at the time, but is now under significant strain. I will get to that in a moment. And even water infrastructure is a serious issue in the United States, if you can believe it, which isn't just an issue of inconvenience, which you could say is the case for roads, for bridges, and so on, but it is actually a public safety issue. And the time is now, and it's extremely critical. As you know, under Trump, there was a significant will to address the infrastructure gap, but he failed, and he failed miserably because he didn't go about it the right way. He wanted to simply remove the restrictions, environmental requirements and planning requirements to incentivize the building of infrastructure, but of course it never happened. And he was unwilling to subsidize states in order to support the efforts. That didn't work. And so we find ourselves with 4 lost years and a new administration that has a significant objective and initiative in place of more than $2 trillion to address this issue. So I'm very excited about it. If you go and look at Joe Biden's speech from a couple of weeks ago, where he reveals his infrastructure plan, there are a couple of very interesting things. He mentions Dwight Eisenhower. He mentions the interstate highway build. He mentions the space race. He mentions putting man on the moon. He mentions all of these things because he has had, I believe, what I like to call a Sputnik moment. And the Sputnik moment refers to the 1957 launch of the Russian satellite Sputnik 1, which was the first artificial satellite put into space. And it gave the United States the realization that it was falling behind and that another country was about to surpass its technological and potentially economic development. And that gave rise to the initiatives that I talked about in the late 1950s and 60s. So Dwight Eisenhower had a crisis. He had the Second World War that the country was still rebuilding from. And he also had an enemy. He had the Russians, he had communism. Joe Biden has exactly the same set of circumstances. He had the global health pandemic as a crisis, and he also has an enemy, but that enemy now is China. And by the way, you might find it amusing that the Russians were so proud of that Sputnik launch satellite launch in the 1950s, they called their coronavirus vaccine Sputnik 5. So it does tell you a lot. But Joe Biden has, of course, the crisis to repair from, and he has an enemy. That enemy this time is China. He mentions China 6 times in his speech. The competition is China. China's eating our lunch, and we need to address this. And he's not wrong, because if you fly from Washington Dulles Airport, to Beijing, you'll be flying from an airport that is serving the capital of the free world and is consistently ranked one of the worst airports on the planet. And you will be landing at a brand new Beijing airport that will make you feel like you're landing on another planet. The difference is the gap is extremely stark, which brings me to the opportunity set. So the infrastructure gap that I refer to is most certainly a developing market issue because our infrastructure is old. It requires refurbishment, repair, and improvement to make it fit for purpose. And in emerging markets, it's a different set of opportunities, mainly built around new infrastructure to address rapidly growing economies, rapidly developing society. And if you go to China and you land at that airport, the next thing you do is you get on a high-speed train that runs on magnetic lift at 600 kilometers per hour. So it's 2 very, very different worlds. So let's talk about fiscal stimulus. This isn't just a US issue. We all know about the Biden plan, which still has to be put into place. But we have in Europe, where I live, a tailwind of fiscal stimulus that is built around a green recovery. And that green recovery, that sustainable recovery objective, is mainly as a result of society's requirements for a clean solution. And of course, that evokes renewable energy, clean transportation, a circular economy, the use of clean hydrogen, and very importantly, the renovation and efficiency improvements in existing buildings and homes. So it is a multifaceted approach. I've discussed Joe Biden. He has an ambitious plan. He still has to get it through. This is about US competitiveness. This is about the United States catching up to China in many respects, which sounds incredible when I say it, given my experience over the years and watching China go from a developing to very much a developed market economy with a long way to go. So what are the long-term trends? Why am I so excited about this asset class? I've addressed renewable energy. This is possibly one of the only globally coordinated efforts to address a serious risk to the planet that we've ever seen. It requires incentivization. It requires significant capital investment, and infrastructure businesses are at the heart of that, mainly in the utility sector. Most people think of utility businesses as defensive, a little bit boring, a little bit sort of not worth paying attention to, but they are at the heart of climate change in terms of addressing the opportunity by way of transitioning their energy mix. Transportation of the future is, of course, another area which requires physical infrastructure in order to accommodate it. We have in our own strategy a digital infrastructure component that revolves around the physical infrastructure assets that are required to manage an increasingly digital world that we live in, much the same as exactly what we're doing now. We could not be doing what we're doing now without data centers, without fiber optic networks, without mobile phone towers. These are critical digital infrastructure assets and an area of significant growth. As I mentioned earlier, water and waste management, in other words, addressing the need for a more circular economy, is another significant opportunity, in particular in developed markets such as the United States. And by the way, one of the cornerstones of Joe Biden's infrastructure stimulus plans, as is the traditional need for roads and bridges to be invested in. And then finally, we have, of course, a changing world with social and demographic changes that require a very important social infrastructure investment. And what I mean by that is hospital infrastructure, for example, which, as we know, given the events of the past year or so, have been strained significantly and need to be made better fit for purpose and require more and more capacity, just by way of example. I will touch on the digital infrastructure component of what we look at, just to highlight how exciting the growth path is for these types of businesses. We all know that developed countries have quite a high level of internet penetration, but that doesn't mean everybody's getting the same speed. My father lives in a very small village in Portugal. I think the average age of the village is probably in its 70s, and it's maybe a few hundred people in this village. But he gets 1 gigabit per second internet connectivity straight into his house, which is about 5 times what I get sitting in my own house here in London. So there is significant potential investment, not just in the connectivity, but in the speed. And that requires, of course, physical infrastructure. Developing countries, of course, have a long way to go to catch up to penetration rates. And this is something that brings about the well-being and the sustainable development goals of society in developing countries. Mobile traffic growth, as we all know, is growing exponentially. Again, not just because of the number of connections, but because of the data requirements of the various applications that we use on our handsets, and the Internet of Things, which is primarily an opportunity for 5G networks, which is another form of digital infrastructure, is growing very, very quickly as well. So what it comes down to is opportunities such as 5G rollouts, which requires a completely different network infrastructure than what we're used to in 2G, 3G, 4G. Again, digital infrastructure opportunities. Ultra high speed fiber is another area of opportunity. And as I mentioned earlier, hydrogen infrastructure is an important element of a move to ultimately a hydrogen powered economy. And what I mean by that is traditional fixed infrastructure assets such as pipelines, such as storage facilities, such as processing facilities to manage this very important fuel of the future. So I will summarize, and I'm more than happy to start taking questions after this, that we do have a significant need to address the infrastructure gap. These infrastructure assets that are existing, that are old, that are post-war deployments, need modernization, improvement, and expansion. And developing economies require new and better infrastructure. All of this comes at a time when there are coordinated global efforts to not only stimulate economies by way of fiscal stimulus, but by way of monetary stimulus. And the incentives that are being put in place are enormous opportunities for capital investment and the returns that go with it. And then finally, we are excited about the powerful long-term trends and structural growth opportunities that come from this very exciting asset class in future decades. So with that, I am going to stop sharing my screen. I am going to turn my camera back on and hope that you have been stimulated to put forward some questions, and hopefully beyond that, I've generated some interest in what I think is a very, very exciting asset class.
Excellent. Thank you very much, Alex. So we have one of the first questions coming from Sebastián. So do you invest in listed companies, private equity, or different projects?
Thank you for the question. M&G, the company I work for, has investments across various areas of infrastructure. We have a private infrastructure group that invests in private equity infrastructure. Okay. We have a group called the Catalyst Group that invests in impact-oriented private infrastructure assets. And then we have myself that invest in listed infrastructure businesses only. They are very different ways. And by the way, we also have a debt infrastructure team. So infrastructure is very much an expertise that we have in-house. I happen to invest in the listed space. I believe it's one of the most exciting areas of infrastructure investment for a couple of reasons. Number one, the valuations of listed infrastructure businesses are much more attractive than for private transactions. Why is that? I think there are a couple of reasons for it. One is the type of buyer. The buyers of private infrastructure are sovereign wealth funds, insurance companies, pension plans, long-term liability facing institutions, entities that need long-term cash flow streams to match those liabilities. And they are willing to pay very high prices for these very rare, scarce assets. Investing in listed infrastructure, we're investing in the same things, the same assets, the same characteristics. My investment horizon in my portfolio is multi-decade, looking for very long life cash flow streams, but they come by way of listed companies. But the market treats listed companies differently. They like to be very short-termist, value things on next year's cash flow, which makes no sense for a multi-decade infrastructure business, which gives us a great arbitrage opportunity to capture that valuation gap. One of the other reasons I'm quite excited about listed infrastructure, it allows us to be flexible. We have the liquidity of the markets available to us should life change like it did last year, and allow us to reallocate capital in areas where we see more opportunity. So we do that. We are very much a low turnover buy and hold type of a strategy, but when opportunities arise, we obviously jump on those opportunities. So that's how we think, and many of the businesses that we invest in are more than single asset infrastructure businesses. Some are single asset, like we have, for example, in our portfolio, an airport business that has a single airport. But many of the businesses actually have a portfolio of infrastructure businesses. And the requirement for us is that they have a physical asset base. We don't invest in businesses associated with infrastructure, like construction companies or steel companies, cement, those kinds of things. Even though they will benefit from an infrastructure cycle, the way we invest in the asset class is specifically around physical asset-backed listed businesses.
Great, thank you. So just as a quick reminder, if you wish to ask a question in person, please raise your hand and unmute your microphone. Alex, in terms of, well, we have another question here. In which countries do they invest, and where do they see more opportunities in small emerging countries?
Okay, I see that question, but I see one just before it that I'll answer first, which will help me answer the second one. Does that make sense?
Sure.
So the question is, what are the main characteristics of the listed infrastructure stocks that makes them interesting, and are they a hedge to inflation? Okay. The first thing to say is that the listed infrastructure universe is very large. There are many, many companies, many different types of companies. And you can probably arrive at roughly 1,000 companies globally that could be considered listed infrastructure. Our own strategy makes a very strict definition around our listed infrastructure investable companies and narrows that list down to less than 300. And one of the key criteria for us is that any company we invest in my strategy, grows its dividend over time so that we can deliver a growing income to our unit holders. There are many infrastructure businesses that pay a high yield that never grows, which is effectively a bond proxy and is actually very vulnerable to inflation because it effectively trades like a bond. High yield, no growth is not something that we invest in. We happily accept a slightly lower yield as long as we expect that that dividend will grow. And the characteristics of listed infrastructure stocks are mainly long life, consistent, reliable cash flows, because these assets are typically highly contracted and have a very reliable, steady cash flow stream. For us, it has to be a growing cash flow stream. These kinds of companies are also quite defensive, because if you think about it, they are less vulnerable to the economic cycle. If we go back to the utilities sector, which I mentioned earlier, this is a sector that was actually growing earnings last year, where most of the rest of the market was actually contracting because of the economic collapse. So the consistency and the reliability of these cash flows makes for quite defensive characteristics in the underlying equities. Now, they are equity businesses, and of course they are subject to the volatility and the panic and the sentiment in equity markets, but that gives us wonderful opportunities. So if I then go to the next question, oh, and by the way, on inflation, my portfolio is built to benefit from growth. And when you have growth and you have the inflation that comes along with it, and even if you have higher interest rates, that will tend to benefit the businesses that we invest in. So you think about a toll road, for example. What do we want from a toll road? We want traffic. We want cargo. We want passenger cars. And inflation that comes with it allows us to raise the tolls to charge those motorists to use the toll road. And then, of course, we get to invest capital as the needs for that toll road network grow. It needs to be widened, expanded, and so on. So we welcome inflation, and we can demonstrate that the way we invest in listed infrastructure is such that inflationary environments, higher interest rate environments, further out the yield curve actually benefit the exposures that we have in the fund. So if we go to the next question on what countries we invest in, we are mainly invested in companies domiciled in developed markets. So roughly half of the portfolio is US, Canada. We've got roughly 15% in the UK. We've got 20% plus in Europe, and we have a little bit of Asia, Australia, and so on. Now, why don't we have investments in countries like the Philippines or Malaysia or Thailand? And we don't at the moment, mainly because of the criteria we have around growing dividend streams. It's tough to find companies listed on local markets that have the governance, the discipline to grow their dividends consistently over time. And so we typically invest in companies that are in developed markets with exposures in emerging markets to capitalize on the opportunity. So let me give you an example. We have a holding in the fund in our digital infrastructure segment, which is a mobile tower owner operator called American Tower. Now, if I asked you to guess what American Tower does, given the name, you'd say, well, they probably have American mobile phone towers. And you're absolutely right. They do. They have a wonderful nationwide portfolio of US and Canadian mobile phone towers. But where is their growth coming from? Well, it's coming from those existing towers as they build out and network density improvements, 5G and so on. But the real growth opportunity for that company is its deployment of towers and its capital in emerging markets in parts of Latin America, in the western part of Africa, and in India. In fact, they have more towers in India than they have in America, so perhaps they should be called Indian Tower. But here's an investment in a US listed dividend growing, high quality digital infrastructure business with global exposure. And we do the same thing with our Hong Kong investments, which have Chinese exposure, for example. So that's how we get the emerging market type of exposure. Now, we do have emerging market investments. We have a toll road business in Brazil, a very high quality dividend growing business. We're happy to take those risks when we can find the kinds of companies that meet our criteria. So it is a global strategy. It is very diversified by country, by region, by sector and subsector, but with that very strict criteria in mind.
Great. One of the questions that I received was what investments you have in Latin America. So you mentioned Brazil. Do you have any other that you can share with us?
Sure. We actually mainly have our exposure to South America, to Latin America, by way of companies listed in other countries. I've just mentioned American Tower and their digital infrastructure investments in Latin America, but we also have an Italian company called Enel, which has a subsidiary Endesa, which has utility businesses in Latin America. We have a company listed in Spain called Naturgy, which also has investments in Latin America in the utility sector. And we have one called AES, and we have one called Contour Global. So there are several non-Latin American listed businesses that give us exposure to the exciting growth opportunities on your continent.
Excellent. And can you share any sort of ESG considerations when you invest in infrastructure?
Absolutely. It's an asset class with an identity crisis in many ways, because the assets that we're talking about, primarily the utilities sector and the transportation infrastructure sector, are associated with the single biggest emissions of greenhouse gases on the planet. Where do we generate the most greenhouse gases? From electricity generation. What's number two? Transportation. So these kinds of businesses and assets are at the heart of the problem, but they are also critical to the solution. So when we consider a business, we need to consider the direction of travel of that business, where its opportunity lies, particularly when it comes to sustainable energy generation. What are companies in the transportation infrastructure sector doing to accommodate the need for sustainability, whether it's toll roads or airports, for example. And so our approach from an ESG point of view is specific to the asset class. We're investing in fixed physical assets that have impact, that are exposed to climate change events. We've had circumstances in California where wildfires arguably related to climate change have destroyed infrastructure assets. We've had flooding events. We've had these kinds of signals that these kinds of assets are very exposed. And where the opportunity is from an ESG standpoint, and certainly from the point of view of positive impact, is in investing in businesses that are in transition and are not just accommodating, but ushering in the solution for climate change. So we've had an ESG process in place for this fund since day one. The fund is actually part of M&G's Planet Plus sustainability family of funds. We are awarded a very prestigious ESG sustainability label just a few weeks ago, which we're very, very proud of. So that that validation is very important to us. And we have a policy document that is a public document that we're happy to share with you should you like some more information. But the point of all of this is that it is specific to the infrastructure asset class, not just a screening exercise.
Great. So we have another question here in the chat. So it's a comparison between infrastructure versus real estate. So what do you think are the main difference in favor of investing in infrastructure versus real estate?
Some infrastructure is real estate. In fact, certain infrastructure assets, I believe, are the new real estate. So what do I mean by that? I talked about digital infrastructure businesses. I talked about the towers. I talked about the data centers, for example. Those businesses are mainly classified as real estate investment trusts in the United States. And they can do that because they have fixed physical assets and they benefit from the tax advantages of being structured in such a way. So real estate, as we all know, it's shopping malls, it's office buildings, it's residential, non-residential, commercial, logistic, industrial, but there are also infrastructure assets. Sydney Airport in Australia is actually structured as a real estate investment trust. So I think it's about being selective within real estate. The long life, consistent cash flow generating characteristics of infrastructure, I think, are a differentiator because it's very different from an office building or a shopping mall. And I think the experience of the past year or so has demonstrated the importance of choosing the real estate assets that one's investing in very, very carefully. But there are similarities because, of course, you do have that fixed strategic barrier to entry type of a characteristic in both infrastructure and real estate, but one has to think about the actual exposure. Who is your customer? How consistent and reliable is that customer? Is it a government? Is it a retailer? Is it Amazon if you're a logistics real estate business? So it's really about getting your hands dirty, as we say, and analyzing the actual exposure and how reliable and consistent it can be. Again, shopping malls had a very different experience last year than digital infrastructure, for example. In fact, one of the key drivers of digital infrastructure growth has been online shopping, taking business away from shopping malls and into the cloud.
Great. So what sort of expected returns and volatilities have you seen during the last years, or maybe comment something in terms of the downside protection?
Well, the last year has been very different from the first 2.5 years. It won't surprise you. This asset class and our own fund and our own investable universe since launch up until the beginning of the global health pandemic demonstrated very low volatility relative to the global equity market, a lower drawdown during down markets than the global equity market, and a quicker rebound from those lows with a beta of in the strategy of between 0.6 and 0.8. Okay. Then the global health pandemic hits, and we have an unusual circumstance where infrastructure assets that would normally be immune to the economic cycle or less impacted by the economic cycle suddenly had challenges that we never thought we would face. For example, airports. We had a voluntary collapse in passenger traffic through airports, as we know. The same for toll roads during lockdowns, the same for public transit. So the valuations of these businesses were severely impacted. And at the same time, with economies collapsing, the need for energy infrastructure was perceived to be less. So the equity values of those businesses came under significant pressure. So as a result, we had more volatility than we would expect. The beta went to 1, and there was more of an impact to the underlying equities than we would normally expect. Now, they bounced back quite nicely, but then we had last year a very strange circumstance where the more exciting areas of the market, as some people see them, did extremely well and left this asset class behind. And I actually like it when that happens, because you get opportunities that you wouldn't otherwise get, people more interested in growthy, exciting tech names than utilities that are engendering the energy transition. But on balance, and since we've launched this strategy, for example, the return has been in the high single digits with a generally lower volatility and lower drawdown than the broader equity market, which is what you'd expect from businesses that are generating roughly a 3.5% dividend yield and growth in the dividend stream of between 5 and 10%. The expected return would be in the high single digits, and that's precisely what we've delivered.
Good. So we have here another question. How do you deal with the government policies exposure?
Very carefully is the answer. Infrastructure businesses are commonly seen as a social good, and many of them can have monopoly or oligopoly power. And as a result, governments tend to interfere, get involved, regulate, manage, and surprise these kinds of businesses. But the good news is we're a global investor, and we can invest in any area, and we are able to invest in the areas where we feel that the regulatory environment and the government support is more favorable than others. So let me give you some examples. The United Kingdom has quite a poor regulatory environment at the moment for investor-owned utilities. So we have a very low exposure compared to, for example, the United States or parts of Europe. Now, we have to also think the way a regulator thinks. What does a regulator want? What does a government want? And if we go back to the infrastructure opportunities, we realize very quickly that in order to get more and better infrastructure, we have to involve the private sector because it's a key element of the solution. And in order to do that, we need to incentivize the private sector to invest its capital. So as an investor myself, providing capital to these infrastructure businesses, I will only invest where I see the capital investment return opportunity, and ultimately that gets driven by the regulator or the government in question. So the good news is, with the need for more and better infrastructure, with the need for sustainable, clean energy oriented infrastructure, electric vehicle infrastructure, and so on, the governments, the regulators are desperate to see the capital investment. And as a result, the incentivization mechanisms and the capital returns I see as extremely favorable. So again, we have to be selective. And when you have political cycles and political change, very often the rules change as well. So one has to be very careful. There are plenty of examples of a regulatory framework changing very quickly because of a shift in the political mood or the political regime. So again, being invested in listed businesses allows us the flexibility to move to where we feel more welcome as investors. And currently, when it comes to regulated businesses, most of our investments are actually in the United States and in continental Europe.
Good. Do you have any kind of risk management strategy?
We do. I have a risk management team that's always knocking at my door. And the good news is they mainly tell me I have more of a risk budget than I realize. I tend to be quite a conservative investor when it comes to this asset class, remembering that I'm looking for sustainable, long life, consistent, growing businesses. But they do tell me that I do have some room to add risk. And so from time to time, I'm able to do that. But the analysis there typically revolves around factor risk. So what are the factor exposures in the fund that I may not be aware of? So what do I mean by that? For example, when one is investing in energy infrastructure businesses, for example, many of them are actually listed in Canada, the country where I grew up. And they are high quality businesses. They are transporting and processing and storing energy products. But they are also listed in a country with Canadian dollar as a base currency, as a domicile currency. And the Canadian dollar happens to have a high correlation with energy prices. So I have a factor exposure, interestingly, that doubles up on the energy, for example, or for example on the Canadian dollar by way of the energy price, even though I'm not investing in any oil and gas producers or oil and gas products. It's more of a correlation. So factor exposures can be very important and can surprise you where they're coming from. And from time to time, we're made aware of that, and it allows us to adjust to make sure that we're diversifying and constructing the portfolio appropriately. So currency risk is something that we need to spend a lot of time on. Factor risk is something we need to spend a lot of time on. And we have some very strict allocation ranges for the strategy across the three categories of infrastructure that we manage: economic infrastructure, social infrastructure, evolving infrastructure, as well as all the sectors underneath. And those kinds of guidelines, those allocation ranges can be very helpful because they avoid you getting into trouble, drifting, going on misadventures, and as does the analysis of factor risk, particularly when it comes to currency. I mentioned the Brazilian company earlier. What are the exposures in a Brazilian listed infrastructure business? Well, obviously the local economy exposure, but also the currency and also geopolitical risk. And obviously, it's a political environment that is quite volatile at the moment. So these are the kinds of things we have to be aware of and size our positions appropriately.
All right. So, Alex, I think that we covered all our questions. So, is there anything else that you wanted to cover before wrapping up?
No, all I would say is that it's a very exciting asset class. We had a power failure in my home just this week, and I got quite excited about that because then I could geek out, as they say. And I called the network provider, and they said, "Yep, there's a high voltage outage in one of the lines. It happens to be underground, and the substation is not getting power." And it's true, I went to the substation, which isn't very far from where I am, and it wasn't buzzing. But they diverted power from another part of the network in order to bring the power back. And then the next thing I know, they're digging up the street outside to fix the high voltage line. So there's a lot that happens that we take for granted. We get up in the morning, we turn on the lights, we have a shower, we check our phones, we have a coffee, we go to work. Once we're out of lockdown, and we visit somebody in the hospital perhaps, or we go for a drink, and then we watch our entertainment in the evening. All of these activities require physical infrastructure assets that we take for granted. We don't realize how important they are until they stop working. So how many of you, if you lost power, you lost internet, you lost water, you lost your natural gas supply, you lost all of these things, that would really change your day. So that's what we get excited about, is the critical nature of this asset class, and that gives us the confidence that our reliance on its provision translates to the reliability of the cash flows and the long-term returns that the asset class can provide. So that's why I'm so excited about it, and I'm glad to share all of this with you because my family isn't very interested when I talk about high voltage lines and substations.
Great. All right, then. So, Alex, thank you very much on behalf of the CFA Society. Again, thank you, and great presentation. And we really look forward to keep hearing from you and M&G Investments as well. So with this, we will close our event for today. Thank you very much, everyone, for joining us, and have a great rest of the day. Thank you.